Most financial advisors will advise you to invest in S&P 500 ETF because, statistically speaking, most professional as well as non-professional investors are more than likely to end up making less returns than the S&P 500 index. But what if I told you that there are 3 ETFs that have historically outperformed the S&P 500? And if you had invested in these 3 ETFs, you would have easily beaten more than 90% of the professional money managers. In this video, we will talk about these 3 ETFs that have outperformed the S&P 500. We will understand what these ETFs are, what their risk profile is, their cost structure, and their performance compared to the S&P 500. My name is Kanak and welcome back to my channel. Your support is what keeps this channel running. So if you find this video helpful, then show your support by liking and subscribing to the channel. The first ETF that has outperformed the S&P 500 by a huge margin is Invesco QQQ. Invesco QQQ is an ETF that tracks nasdaq 100. And nasdaq 100 represents the 100 largest non-financial companies listed on the US stock exchange. So if you had invested $10,000 in Invesco QQQ 10 years ago in 2014, then your $10,000 would have turned into $50,000 by 2024. Whereas if you had invested the same $10,000 in SPY, which is an S&P 500 ETF, then your money would have turned into only $30,000 by 2024. That's a whooping 200% difference. And not just over the last 10 years, but QQQ has consistently outperformed SPY in the last 5, 3, and 1 years. But there is a saying that there are no free lunches. So let us compare the risk of QQQ with that of SPY. Invesco QQQ had higher volatility of 3.3% compared to SPY's 2.7%. The way to interpret volatility is to look at it as a measure of price fluctuation. Higher the volatility means higher price fluctuation. So in this case, QQQ had higher price fluctuation compared to SPY. Now there is a very useful metric called Sharpe ratio, which measures the return of a fund relative to its risk. In case of QQQ, the Sharpe ratio is 2.86, which is higher than that of SPY at 1.95. This simply means that for every 1 unit of risk, the returns on QQQ have been higher than that on SPY. Now let's talk about cost. In terms of cost, QQQ has 0.2% expense ratio, whereas SPY has 0.09%. So for every $10,000 that you invest in QQQ, you would be paying $20 annually in management fee, whereas you would be paying $9 in case of SPY. So to summarize, despite having higher risk and higher cost, QQQ over the last 10 years has given higher risk-adjusted returns compared to S&P 500. The next ETF that has beaten the S&P 500 over the last 10 years is SPYG. SPYG is an S&P 500 growth ETF, which means it picks companies from among the S&P 500 companies that display the highest growth characteristics such as sales growth and earnings growth. So if you had invested $10,000 in SPYG 10 years ago, then that $10,000 would have turned into $35,000 by 2024. Whereas the same $10,000 would have turned into only $30,000 in S&P 500. SPYG has consistently outperformed S&P 500 over the last 10, 5, and 1 year. Similar to QQQ, SPYG has displayed higher volatility, or to put it in other words, the price fluctuation for SPYG has been higher compared to SPY. However, SPYG also had higher risk-adjusted returns, that is, higher Sharpe ratio, which means for a comparable amount of risk, the returns on SPYG was higher than that on SPY. Now talking about cost, SPYG is a low-cost ETF, and the expense ratio is only 0.04%, which is lower than 0.09% of SPY. So to summarize, despite having higher risk, SPYG has given higher risk-adjusted returns than S&P 500. The next ETF that has consistently beaten the S&P 500 over the last decade is SPHQ. SPHQ is an Invesco S&P 500 quality ETF, which is based on S&P 500 quality index. This index specifically invests in high quality companies of S&P 500 index. There are 3 metrics that define the quality of a company. The number 1 is return on equity, accrual ratio, and financial leverage. These 3 metrics filter out companies that generate high cash returns relative to the company's equity by borrowing less money. Now, if you had invested $10,000 in SPHQ 10 years ago, your money would have turned into $31,000 by 2024, only about $1,000 more than what you would have made by investing in S&P 500. The performance of SPHQ has been only marginally better than SPY in the last decade. In the last 12 months, the performance of SPHQ has been slightly worse than that of S&P 500. In terms of price fluctuation, SPHQ had higher price fluctuation than SPY. But similar to our previous ETFs, SPHQ had better risk-adjusted returns than S&P 500, even though the difference is only marginal. In terms of cost, SPHQ had higher expense ratio at 0.15%, which is higher than the expense ratio of SPY at 0.09%. So to summarize, In terms of risk-adjusted returns, SPHQ has performed better than S&P 500, even though the difference is only marginal. One important thing that I want to tell you is that past performance does not guarantee future performance. And once the market knows the strategies that outperformed the S&P 500 in the past, the market overweights on such strategies which could cause it to underperform in the future. If you find this video insightful, then show your support by liking and subscribing to the channel.